Every year, the Indian government needs to borrow trillions of rupees to fund a massive pipeline of domestic infrastructure and development projects. To raise capital, it issues government securities, or GSECs. Investors lend money today, and the government promises to repay the principal plus interest later. For decades, buyers of these securities were almost entirely domestic: local commercial banks, pension funds, and insurance companies. Collectively, these local institutions and the Reserve Bank of India hold nearly 75% of all Indian government debt. Relying so heavily on a domestic lending base creates a ceiling on how much the government can raise. To fund its next phase of growth, India has to look beyond its borders to the deeper pools of global capital. India is one of the fastest-growing major economies in the world, yet international investors are almost entirely absent from its sovereign debt market. The data shows a massive imbalance. Foreign investors currently own a mere 2.96% of India's government securities. This gap was largely a result of strict investment quotas. For years, the government capped exactly how much foreign money could enter the country. These limits were rigid. Once the cap was hit, the doors were closed, and no additional foreign investment was permitted, regardless of demand. To tap into the capital needed for its future, policymakers realized they had to systematically dismantle these historical barriers. The first major shift arrived in 2020 with the Fully Accessible Route, or FAR. This policy designated a specific set of government bonds that eligible non-resident investors could purchase without any PAPs or quotas. The impact was immediate. This accessibility earned India a spot in the world's most influential bond indices, including JP Morgan and FTSE Russell. Inclusion in the JP Morgan index alone was estimated to bring as much as $30 billion of new capital into the country. Removing those quotas was the first real proof that India's debt market could successfully integrate with the global financial system. Now, the government is moving further, voluntarily sacrificing tax revenue by exempting foreign investors from taxes on interest income and capital gains. It is a calculated move. Global asset managers and pension funds have endless options for sovereign debt. They don't choose Indian bonds by default. They constantly weigh the potential returns of emerging markets against high-stability alternatives, such as US and Japan. When these investors compare their options, they look at friction factors: how complex the tax rules are, how liquid the market is, and how easily money can move across borders. This tax break is a strategic attempt to eliminate a major point of friction. By making its debt more competitive, India aims to expand its lender base and eventually lower the cost of government borrowing. These reforms are pointed toward one final objective: a listing on the Bloomberg Global Aggregate Index. Index inclusion acts like an automatic distribution network. It forces index-tracking funds to buy a country's debt by default. The stakes are massive. Reports suggest Bloomberg inclusion could trigger up to $25 billion in automatic inflows. The window to act is closing. In January 2024, Bloomberg postponed India's pace over market access concerns, but they have scheduled a reevaluation for the second half of 2026. These tax exemptions are a timed effort to clean up operational issues and strengthen the case for inclusion before that 2026 audit. But there is a core limitation to any tax break: it cannot protect an investor from currency risk. Global institutions measure their real success in their home currencies. At the end of an investment, rupee returns must be converted back into dollars or euros. If the rupee weakens, the exchange rate can eat into those gains or erase them entirely. This underlying fear is why deep, dollar-backed markets in the United States remain the global default, even when they offer lower yields. India has spent years removing domestic barriers and stripping away tax friction. The final question is whether these reforms are enough to outweigh currency risks and redirect the flow of global institutional capital.